Good evening. Good evening. Good evening. Hi, it is that time of the week again that I can try and answer a few questions, maybe give a bit of guidance, whatever. So, ladies and gents, please pop some questions in and let's see what I can help you with. Hi to all of you. Thank you very much for joining us. Baie lekker om met julle almal te gesels. Just a quick thing. People don't want to normally go to a financial advisor. People don't want to speak to a financial advisor because they're always worried about what the financial advisor is going to try and sell them, what the financial advisor is going to charge them, etc., etc. And I had a very interesting situation this week where I spoke to a client and he told me that he's done all his investments himself. He has a substantial amount of investments, as a matter of fact. But when we looked through his investments, which he has now all done in his own personal capacity, the one thing that we came to notice is even though he's got a substantial amount of investments, his investments is not structured nearly in the right risk profile for him. So he is way too conservatively invested. And because he did all the investments himself, and because he did not understand the different portfolios that he bought into, some of these portfolios were charging him 1.75% on management fee, portfolio management fee, etc., etc. So after we looked at everything and we rebalanced it, he's sitting with a portfolio which is much better structured for his personal hopes and needs and what he wants to accomplish. And at the end of the day, I'm going to save him on average about 0.75% on cost, which is substantial, especially if you're going to be saving that over a long period of time. So that's just something for everybody that wants to speak to or wants financial advice but don't want to speak to a financial advisor. Consider it. If you find somebody that you can trust, it will be well worth your while. That's number one. Number two, when you speak to a financial advisor, you don't have to take their advice. You can always say no. And number three, you can always get a third and a second and a third and a fourth opinion and then eventually go with what you want to do. Takes a bit of work, but it's worthwhile in the end of the day. So let's see, I've got a number of people that's popped in and I've got a few people that have said hello and hello to all of you. And let's see what the questions is that we are getting at the moment. Middag Dirk, ons sal oorslaan na Afrikaans toe as ek Afrikaanse vraag kry, meneer. En hierso is hy, Wouter Ellis. Hi meneer, hoop dit gaan goed. Jammer, sal nie die live kan kyk nie. Ek is by 'n karate klub besig om te coach. Wouter is fine, meneer. Jammer, jy kan nie bywoon nie, maar jy is welkom om te kom kuier en met my op 'n ander platform 'n afspraakie te maak en dan kan ons 'n koffie drink. Do you do arbitrage? Man, do I do arbitrage? So here's the question is, when is it doing arbitrage and when is it just advising on arbitrage? So I don't do arbitrage personally. We don't have a mandate to sell arbitrage. I understand arbitrage and I've got a company that I absolutely trust when it comes to arbitrage. And what I do is I talk to people about arbitrage, where I think that arbitrage can fit into their portfolio. Part of the portfolio structuring I was actually talking about just now. And if the person says, listen, yeah, I'm keen, I want to do it, then I refer people to a company that we trust to do arbitrage. And they can do arbitrage through this company. But no, in our business, under our FSP license, we don't do arbitrage ourselves. But I like arbitrage. I must be honest with you. I think it is something that your investment houses, or the majority of the good and big investment houses, is not very keen to go into yet, not very keen to incorporate into their portfolios too much at the moment. I think they're slowly but surely dipping their toes into that pond. but still sticking with the tried and trusted, buying and selling equities, bonds, etc., etc. But yeah, I like arbitrage. I think it's a lovely place to go with a portion of your investment, not with everything. Okay, let's see what is next. And sorry, folks. Oh, there we go. Okay, I just need to get back to where I was to see who's next. Okay. Fayyad, in general, what are your thoughts on a provident fund that choose your portfolio selection for you? Fayyad, look, this is the company that you deal with. It's their prerogative in terms of how they want to structure that provident fund. So some company says, listen, I want my employees to have options with regards to what they do. Other company says, no, just do one thing, get it over and done with. Although that is being phased out, and I think at a very quick rate. So the majority of employers these days that offers a provident fund, they normally offer at least 3 options in terms of portfolios. And at the end of the day, they will give you a default portfolio if you do not tell them, I want to be in the low, medium, or high risk portfolio. So if you are with a company that only has a default portfolio and you can't do anything else, I suggest that you get together with your fellow employees and say to the company, listen, we would like some options. We want a bit more of a variety. And it is so easy these days for employers to change a provident fund from having one portfolio to having 3, 4, 5, or even multiple portfolios. So I can't say it's bad. I mean, at the end of the day, if you do have a provident fund and your employer is contributing towards it, you are already getting a benefit that you most probably would not have done in your personal capacity if you were not forced to do that. So that's my thoughts on that one. I wonder what all these gifter badges and everything is. Maybe somebody can explain to me. Martin Alat, hi Corne, is it better to pay all debt you have when you save money, or keep it and invest money rather? So Martin, this is the thing. Number one, I think it goes to financial discipline. Okay. You have to go and every person must determine how good their own financial discipline is. I have worked with so many clients that said that they're going to save money and they just never do. So I think first of all, it's personal discipline. If you can save money and you have that ability to go and save some money, then once you have done that, or once you have shown yourself that you can do that, then the next option or the next thing to do with regards to this specific option, whether to pay off debt or invest the money, is then to go and weigh them up against each other. What is going to be best for me? And a simple explanation that I can give you, and it's most probably not, it's definitely not a straight line. This is just a guideline. The guideline is if you have a debt, and let's say your debt is a personal loan and you're paying 14% interest on that personal loan, there is no investment that can guarantee you a 14% return on investment. There's investments that can most probably guarantee you 8 or 8.5% return on investment. So in such a situation, I will weigh those two up against each other and say, if I put the money into that personal loan of 14%, I know I'm guaranteed that I'm saving myself 14% in interest that I would have paid, and I will pay off that loan. But if the debt that you have is, let's say 9% is the interest rate that you're paying, then the question comes in, your personal opinion with regards to the investment that's put in front of you. If that investment, if you feel comfortable that investment will say, give you a 12% return on investment, and the debt is at 9%, then I would say then you go into the investment, because you will get a 3% higher rate of return on your investment than what you will pay on your interest in your debt. So if you play those two off against each other, you will have a 3% extra saving at the end of the day by rather investing than going into debt. So that is a rough guideline. Don't take it as gospel. It's not the be all and end all. It's absolutely a rough guideline. At the end of the day, I think the most important thing is to sit and go and plan about these things, and then to make a decision. And this is one thing that also comes in with regards to this, the peace of mind factor. If you have an interest rate of say 11%, you're only going to get 9% return on your investment, or vice versa. The question is, what is going to give you more peace of mind? Sometimes that 2% interest or 2% growth is not sufficient. And what I mean by that, for some people, it is more important to have their house paid off and to have that satisfaction and peace of mind that the house is paid off than what it would be to have an investment that's going to give them a 14% return investment. They feel better and they sleep better at night when they know that the debt is gone or the house is paid off. So it's a tricky one to give a straightforward answer to, but it is a lovely one to sit and play around with when doing planning. Hope that helps you, Martin. Okay, let's go on. Flower Girl, you're back. How's it? Can you talk on unit trusts, extra investment options for people who have RA and pension funds already? So unit trusts, let's just look at what is a unit trust. You all know what the Dow Jones is, the Johannesburg Stock Exchange, the Nikkei, the S&P 500. These are all stock exchanges across the world. And companies go and list on a stock exchange. And if you go and buy a share in a company, let's say you go and buy a share in Harmony Gold Mines, then you are buying a share that's on the stock exchange and you are reliant on what that share does, up or down, up or down, up or down. So what is a unit trust? A unit trust is basically just a combination of shares. So you can choose, for example, a gold and mining unit trust. And then you will have a fund that has Harmony Gold, Anglo Plats, and all those gold and mining companies in it. And that gives you a bit more diversification because you now not just invested in one stock that you've bought, you've invested in 10, 20, 50, 100, depending on how many is in that unit trust portfolio. So that's how a unit trust works. Now, to take the unit trust further, a unit trust, when you buy that, when you eventually sell your unit trust, when you decide it's time to cash in, then you're going to pay capital gains tax on the growth that you've earned. Okay, so whether one is going to take a unit trust and invest your money in that, or whether you're going to choose a life investment, you always have to go and look at your own personal tax situation. And the normal rule of thumb is, if your personal tax rate is under 30%, then a unit trust is good for you because you will be taxed on what your tax rate is when you withdraw. If your tax rate is more than 30%, then it might be better for you to go into a life investment because on the life investment, you get an after-tax growth on your investment. When you withdraw the money, there's no tax payable. And that is because the portfolio manager who's managing your portfolio is already paying the tax in the fund to SARS. And he's paying it at company tax rate of 30%. And that is why 30% is the benchmark that one normally looks at as to which one you're going to go. Now, extra investment options for people who have an RA and a pension fund already. There are so many. Unit trust, like we just said, or LISP investments, life investments or endowments as they call it, arbitrage that we just referred to a bit earlier, livestock funds where you can go and buy yourself a cow and wait for the return on that cow, venture capital, Kruger Rands, savings investment in the bank, Forex. There's a lot of different investment options that one can choose once you already have an RA or pension fund. This comes back to planning for me. Before you decide to go into different or alternative investments, what you want to do is to make sure that you have maximized your benefits on a specific investment. So maximizing on an RA, for example, are you contributing and getting the maximum tax benefit from the rebates? And then once you've done that and you feel that you're comfortable there, then decide on what is going to be the next investment. So there's a lot of different investment options, but I cannot give you in good faith one answer and say, take your money and go and put it there. It all comes down to the planning at the end of the day. So speak to a financial advisor, somebody you can trust, invest your money there. The money that you will pay in fees, worthwhile, every cent. Let's see who is next year. Sorry, I don't want to skip anybody. So I'm just scrolling back. No dependence signal. Flower Girl, if you've got no dependence and you're single, man, then the world is your oyster. I put 500k in I put 500k in Bitcoin standing on 10k. So Ian, sorry to hear about that, mate, but this comes in with regards to it's chance you take. And I bet you that you took a chance on Bitcoin when it was growing mad. And this is a problem or a mistake that a lot of investors make, is they see something that is growing extraordinary, and then because it's growing extraordinary, then they want to go and invest in it. I don't know if anybody has seen the gold price over the last year. That thing has skyrocketed. And now people talk to me, now people want to buy gold. It's too late. It's too late. Gold is high. Yes, it's going to grow some more, most probably up to the end of the year, after up to the elections, the American elections and everything like that, depending on what's going to happen in the war. But it's already at an all-time high, and it keeps on growing. So I am very scared at this stage to go and venture too much money into gold, for example. Now, with something like Bitcoin, this is the thing. Years ago, when Bitcoin came out, I had a couple of advisors that insisted we have to start selling Bitcoin, we have to start telling people. And I said, listen, the history is not long enough. We can't see a track record, so I'm not happy to go into it. So what I did is I opened a Luna account. And in my Luna account, I put exactly 1,000 Rand. And that 1,000 Rand quickly grew from 1,000 to 1,600 Rand. And all my advisors were, see, we told you so. We have to start investing it. We have to put people's money there. And I said, just hang tight. Let's just see what it does. So that was in about month 8. And then Bitcoin started taking the dip. And this is because the price was pushed up by demand. Everybody saw this thing as growing. Everybody saw it was good. So everybody plunged their money in there. But nobody thought about the thing that at some point somebody's going to say, whoa, this thing is too hard to handle. I'm going to drop it. And then they're going to start selling. And if somebody starts selling, everybody starts selling. So that Luna account went from 1,000 to 1,600 Rand, and by the end of 12 months, I sold my Bitcoin in my Luna account for only 700 Rand. So that's just how the market goes. And I think this is the problem for investors. If they do not have a bit of knowledge about markets, they do not contemplate the fact that one has to go and look at the market overall, at what is on offer, how the market is running. How long can that market run? What is the outside factors that might affect it? So Ian, once again, I'm sorry to hear about your Bitcoin experience. But Bitcoin, one thing is what Bitcoin and other currencies such as Bitcoin is what's used in arbitrage, but that's not how arbitrage works. Just so that you know that part. Flower Girl, you say you're 40 years old. Ma'am, you're going to have to make an appointment with me. I really want to speak to you because I really do think that we could give you some good value for money in terms of service and planning. Simple explanation of the terms EAC and and TER to measure cost across different portfolios. Fayad, you will not believe me if I tell you now that we talk in the insurance industry permanently with these abbreviations. And sometimes you get so used to it that you forget what the actual wording is. Now, EAC stands for average, what do they call it? Estimated average costing. Estimated average costing. TR, can't even remember. Know what it's all about. But in any case, when it comes to estimated average costing, so what that comes down to is to say that, okay, your portfolio management fee is X, your admin fee is Y, the commission is this, the management fee is so here's all the cost. And then basically what happens is that if you have to pay all the cost in year one, the cost on the investment, the total cost on the investment is, let's call it 5.5%. So that's what the insurer says to you. This is what your cost is going to be for this investment if you just keep it for a year. But if you keep it for a longer period of time, let's say you keep it for 3 years, then that EAC will come down to, let's say, 4%. And the reason why it's coming down is because, remember, your initial outlay in terms of costs includes everything. But as you go on, certain fees becomes less and certain fees falls away and certain fees never has to be paid again. Over and above that, your portfolio grows. And because of your portfolio that is growing, you get discounted rates the bigger your portfolio is. So your estimated annual costing starts reducing as the term goes longer. And therefore, somebody that looks at a quotation that's presented to them will see my costing is 5.5%, argument's sake, for 1 year, and then for 3 years it's 4%, and then for 5 years it's 2.5%, and for 10 years it's 1.5%. So all that thing says is if you go and look at all the costs that you're going to be paying, and you just keep your investment for 1 year, you're gonna get hurt. But your intention as investor is, I want to invest this money for the next 15 years. And what that EIC then basically tells you is because of how this cost structure works, if you keep your investment for 15 years, then instead of paying 5.5% per year and you average it out over the period of time, you're only going to pay 1.5% per year. So that's what it is. It's the total cost that's averaged out depending on how long the term is that you stay invested for. Now, I don't know if that was a simple explanation, but I'm trying my absolute best. I hope that helped. Okay, let's see. Martin, helps a lot. Thanks for the advice. It makes sense. I'm glad to hear that. There, I just lost that one again. How's it possible? I don't know. Arafat, 100%, that's how unit trust works. Thank you very much. Thank you for confirming what I've explained. Much appreciated. Mr. 100K just joined your live. Want to know if you know anything about Bitcoin ETFs? No. I honestly don't know anything about Bitcoin ETFs. I'm sure there's some that is being created, but I don't think there's any that are created at this stage. I know that there are companies that are starting with portfolios where they offer cryptocurrency as a portfolio or part of the portfolio, but I honestly don't know of any company at this stage in South Africa, for sure, that offers a portfolio that's made up of cryptocurrencies. So I can't tell you on this one, Mr. 100K, but I'm sure it will come. And the moment it comes, or the moment it becomes a thing, I will hear about it, because every portfolio manager and economist that gives us advice and we attend webinars, they will tell us as when some of these new things come into life. Thank you, Mr. JMF. If you know anyone that could benefit from it, please share the live. Thank you, Mr. JMF. Yes, that I like you. I like you lots, man. Ilana, I shall become Ilana. Can you speak about endowment policy and its benefits? Yes. So an endowment policy is what I refer to these days as a life investment, Arafat. So endowment policy is where you go and invest an amount of money. And it doesn't matter if you're going to do a monthly investment or if you're going to put in a lump sum of money. But you go and invest this money with the intention of not touching the money for at least 5 years. And then anytime thereafter. So once you take an endowment, there's certain wonderful things that they offer you. Number one, it's taxed within the investment. So because it's taxed within the investment, after the 5-year period, whenever you withdraw and whatever you withdraw is after-tax money, because it's already been taxed. And I know in the industry, when people talk to you, they talk to you about tax-free money. You're now going to get tax-free money. Not tax-free, but it's already been taxed. So this is the nice thing about an endowment. irrespective of how long you're going to keep it. From year 5 onwards, every withdrawal you make out of that thing is after tax money, and therefore you don't pay tax on it again. The other thing that's wonderful about endowment is, although the time period is 5 years, you get 2 opportunities to withdraw money within that 5-year period. So basically, if you were to invest your money and then in year 2 you suddenly have a crisis, you need some money, you can draw some of the money, and then year 4 you have a crisis again, you can draw money again. And here's the nice thing is, with whether it's the first or the second withdrawal, whether you just make one withdrawal or you make 2 withdrawals, you can choose to draw all the money out of it. So you are not so tied in that you can't get out of it. On endowments, you can choose the risk that you want. So you can choose portfolios that's low, medium, and high risk. So that's the other nice thing about endowments. So I specifically like endowments as a way of making provision for the future, because it is, after all, a forced savings vehicle. You are forced to put your money away on the month-to-month basis. Okay, and the reason why it works like this is it's part of tax legislation. The rules around endowment has been written in this fashion, that it has to be there for 5 years, and then you can draw this after tax money, and you can only invest it by making a debit order or a EFT contribution towards it. And this is all to try and make sure that no fraud commits. And when I say that no fraud commits, is in the past, before we had all the FICA legislation and everything, fraudsters, scallums, would have R1 million and invest the money, because they could put it in cash, they could, whatever the case might be. So somebody stole R1 million from a bank, they would take that money, they would come to the financial advisor, say, give me an endowment of R1 million. Tomorrow they pay R1 million cash into the bank account, and a month later they withdraw the money again. Now they've washed the money. Now it's not dirty money again. And it's because of this that the legislation in part says it's 5 years. They want to make sure that fraudsters can't wash their money through this investment vehicle. Okay, so that's just a little bit on endowments. There's plenty more that one can discuss, but I think those are the most important points that I just touched on there. Hilton, addicted my advice. Thank you, sir. Yay. I feel fantastic when people say things like that. It makes me feel that what I'm giving through is of value. So thank you very much, Hilton. Appreciate it. Okay, it seems like there's no other questions. So while I wait for somebody to pop another question into the chat, what shall I talk to you about? Okay, I was alluding to financial advice a bit earlier. Oh, Arafat, 100%. I'm an advisor by profession, so I've learned a lot. So Arafat, if you are an advisor, okay, if you are an advisor, mate, make contact with me. We have got an offer in our company that I believe is the best and that nobody else can match. And I also believe that we've got the best program in our company to help people grow their business, like an actual businessman, and not to just sit and hope and pray they get new, they get new clients. So go and check in my profile, my WhatsApp, and contact me. Let's get together, let's drink coffee. Let's see where you are and what we do. Maybe we can just help you out. Okay, debt review, Lebogang. Debt review. Man, I hate debt review. And the reason why I hate debt review is because I think that companies that do debt review, they don't really help clients. That's my honest opinion, Lebogang. And this is the reason. When you're going to debt review, this is what happens. You're sitting with a bunch of debt. You've got a house, you've got a car, you've got 3 different loans, you've got a credit card, all of this, and your repayments is just too much. Your repayments on all this stuff is 10,000 Rand a month. You can't afford to do that. Excuse me. You can't afford to do the 10,000 Rand a month. So then you go to debt review. What does the debt review company do? Very simple. The debt review company goes to another company where they can borrow money, and they negotiate with them. They say, okay, this is the house debt, this is the car debt, the credit cost, or whatever the case might be. If we put all of this debt together, okay, the total debt is going to be 1 million rand, and she's paying a 10,000 rand a month towards it. So what we're now going to do is we're going to put all of this into a pool, and then we're going to say to her, okay, now you're going to pay us 5,000 rand a month, and that's enough to service your debt. So you've got an extra 5,000 rand in your pocket. But what they do now is then they're going to extend the term. Let's say they're going to make it the 10 or 15-year term. So this is what happens. You are paying less on your debt, but you are paying longer. So you are paying a lot more in terms of interest. And that's why I hate debt review, because I don't think it helps people. I think it puts people in a worse position. So what I would like to advise people is, number one, get a budget to work on. Okay? And then number two, if you are in a debt situation that you have a lot of debt, go and plan, put a plan in progress to pay off your debt. So you go write all your debts down. You're going to pay down every interest rate that you pay to each of those debts. Then you start by paying off the debts with the highest interest, or which are the smallest debts. So you pay the absolute minimum to everybody else. And that piece of debt that you can pay 200 Rand a month on is the minimum. You pay 200 Rand, and then if you pay the minimum to everybody else and you've got a spare 200 Rand, you throw that 200 Rand in there and you kill that little debt. And once you've killed that little debt, then you take that 400 Rand a month and you move on to the next debt and you kill that debt. And then the next debt and you kill that debt. And in that way, you get out of debt. Number two, if you do not pay your credit card for a month or two, let the bank cry. It's going to be their problem. They are not going to be happy with you. And trust me, anybody that listens to me when it comes to this type of stuff that's in the profession or such is not going to like me either. But if you skip 2 or 3 credit card payments, but you catch up at a later stage, no problem. Third thing is, if you go and speak to all of your debtors and you tell them the situation that you are in and you negotiate with them, you will be surprised how many of them will say, okay, listen, let's help you make a plan. So before you go into debt review, go and speak to your debtors, go and work out a plan. And I promise you, you will get out of debt much quicker if you do that than what you would if you go to a debt review company. There's one very important point that you must remember: financial discipline. Nobody gets out of debt if they do not change their ways and become financially disciplined. Seen plenty of people that's actually that paid off their debt, that got out of debt, and 6 to 12 months later, straight back into debt, because they managed to get it paid off with the help of a debt review company or something like that. But they never learned the financial discipline, went back to making exactly the same mistakes. Okay, Lebogang, I hope that helps. Learned something new today. Great stuff, Lagel. I'm glad if you learned something new today. Let's see, where am I now? I've missed. Oh, shit. Sorry, folks. There, we've done that one. I've spoken to that. Arafat, we've spoken. Debt review, we've done that. Can you speak about an income protector? Okay, Arafat, yes, I can speak about an income protector. So, income protector is what people take out to make sure that in the event that they are either temporarily or permanently disabled and cannot work, that they will get an income to replace the existing income. So temporarily disabled does not mean that you are suddenly in a wheelchair or whatever the case might be. Temporarily disabled can be something such as you have a serious sickness, like a lung condition, like people had over COVID, and you end up in hospital for 6 or 8 weeks. So income protector is a benefit that you take out that you say my income is 10,000 Rand. I want an income protector for 10,000 Rand per month. And then you get the option to have it for temporary income, saying I want to make provision if I'm not going to be able to work for 6 months. Or I want to make provision that if I can never work again, that it pays all the way until my retirement age of 65. And that's what an income protector is. So with companies that offers pension funds and provident funds and group benefits, they normally have an income protector already built in. When it comes to individuals, they have to take out their own income protector. Here's the thing with income protector. You can only take out an amount of cover that is equal to your net income. Okay? Because income protector is not taxed. So, if your gross income is 30,000 Rand a month and your net income is 25,000 Rand a month, you could get an income protector of 25,000 Rand a month. And the reason why you can only get what is equal to your income is because all insurance is to put you back in the same situation as what you were. You can never be enriched by insurance. It doesn't matter whether it is life insurance, disability, income protector, severe illness, short-term insurance, car insurance. Every type of insurance is always to put you back in the position you were, not to enrich you. Okay, so that's just quickly on income protector. I like it, but I like a combination of income protector and lump sum benefits even better. But would it be better to put extra money in my RO or into my pond? I have a credit card. But I think you missed the discussion that we had a little bit earlier, where I talked about where should people invest. And deciding where you're going to invest is going to be determined mostly by what your bond rate is versus what the return is that you can get in your investment. But here's the nice thing about retirement annuities, and I would actually say that retirement annuity in a case like yours is for me the better option. If you put money into a retirement annuity and your tax rate is 31%, you get 31% of that back. So if you put in 1,000 Rand, you're going to get 310 Rand back from the receiver at the end of the year. But in your investment, you still have 1,000 Rand. Now, if you take that 310 bucks, you also put it back in there, because remember, you've already paid it. SARS has just given it back to you. If you put it in there, you've already got a 31% return on your investment. Now, let's say you've got a 10% return on the actual 1,000 Rand you put in. That means you're up to a 41% return on investment. And the kicker is the money in the retirement annuity grows tax-free. So when it comes to a question like this, I would say it's 99.9% of the time, I think the RA is going to beat the bond. But it also does come back to planning, and it comes to financial discipline. Because it doesn't help to go and put money into an RA, but then you don't service your bond, or you don't feel peace of mind, or you don't feel comfortable. So it all comes down to those things. The fact that you have a credit card, I think make sure you pay your credit card off. Credit cards is never a good thing. The interest rates are ridiculous, and it encourages people to spend money that they don't have. The only good credit card is a credit card that's paid off and cut up. Okay, tax-free savings. Do they all make the same interest? Okay, tax-free savings. Do they all make the same interest, or do different companies have different rates? Lebo, indeed, different companies, different rates. So if you take out a tax-free savings account with a bank and you do it in the form of a savings account with the bank's going to tell you we're going to give you 4% or 5% or 6%, whatever the case might be. But if you do a tax-free investment through an investment house, then you can choose the portfolio that you want to invest your money in. So if you're going to choose a money market portfolio, you're most probably going to get the same growth or interest that you would have gotten in the bank. But if you go and choose an equity fund or global equity fund, and that fund performs at 10 or 12 or 14%, then that's the growth that you get. So no, not all tax-free plans gives you the same rate of return on your investment. It all depends on the underlying portfolio that's in the fund and how good that portfolio is doing as to how much growth you're going to get. So it's a lovely fun. I personally, I'm not the biggest fan of tax-free plans, but there's a place for it in the market. And then what makes it good is if you have a good portfolio, because if you do your 36,000 Rand per year, if you can, and your 500,000 Rand over your lifetime, and you just leave the money there and you are invested in a good fund that gives you 9% or above, man, what a lovely investment to have one day. Arafat, let me join your WhatsApp. Fantastic, do so, brother. Like I say, in my profiles, my number, contact me. Debt review is a scam. Sheila, thank you very much. I think it is a scam as well. I think that, and you know what, I think it's one of those things. I think a lot of things in life are started with very good intentions. But then it becomes a business and the business needs to make profit and then it turns into something else. I have dealt with a few debt review companies in my life where I've tried to get clients out of debt review. Yeah, I can't say that I'm very happy with any of them. Okay, let's see. Mr. Nicholson. Whoopsie, there we go again. Lost that one for a second. Where's Mr. Nicholson? There we go. I'm driving a Golf 8R. Installments are about 21k. Mr. Nicholson, why the hell are you doing this? Who are you trying to impress? We buy things to impress people that means nothing in our lives and just to pain us at the end of the day because of the cost. Do yourself a favor. Go and sell that thing and buy something that can take you from point A to B. That's the idea of a car. The idea of a car. Yeah, if you want to be flashy and then have the money to pay for it. So I'm not taking you out because I don't know if you've got the money to pay for it, but for crying out loud, 21k a month on a, no, I'll go and trade it in tomorrow. Pleasure Lebo, very true, financial discipline is key, absolutely, I cannot agree more. Jock Bodnors, income protectors for business owners is highly priced. No, it's not, Jock. Absolute 100% lie. It is not highly priced. It's priced exactly the same as it is for anybody else. Because the premium on income protectors is determined on the same 4 factors that any other risk is done on. It's your date of birth. Date of birth, income, qualifications, type of job you're doing. Okay? So those factors, that determines what your risk category is. So they talk about a risk rating. If you're risk rating 1, then you're in a very low risk rating and you pay high. If you're risk rating 4, you're high and you pay less. It's all about the risk that's associated with you as a person and the type of job you're doing. But at the end of the day, the calculation is done, whether I'm a business owner or whether I'm working for a company. It's exactly the same calculation. Yes, my income protector might be a lot more expensive than somebody else because I travel a lot. I'm on the road a lot. But for the person that sits in the office most of the time, theirs will be lower because their risk is lower. They're not traveling so much. But in terms of if I put Jock Bartnos, the business owner on this side, and I put Corné Bauer, who's maybe not a business owner on the other side, but the two of us are earning the same income, have the same qualification. You are the company owner. I'm a manager of the company. You spend 90% of the day in the office. I spend 90% of the day in the office. Our premiums are going to be exactly the same if our income is the same and our age is the same. Definitely not higher price, Jock. Whoever told you that, tell them that they're lying. What happens if I got paid 2 times from my first pot? Mate, I don't know. To be honest, I don't know. And number one, you shouldn't have taken the money. You've just shot yourself in the foot. So yeah, let me not say anything more about it. I can't tell you what happened. And quite frankly, you shouldn't have taken money. Okay, Nilas. Hi, can I book a consultation with you online? I am based in Cape Town. Yes, you can indeed. Once again, just go to the profile. In the profile is my WhatsApp. You can contact me there. Alternatively, you can go to the website, which is also in the profile, and then we have a contact page. And then I can send you detail, and I can tell you what times I have available, when, what. Just one thing, and I'm putting it out there because I don't want you to think that I'm misleading you. I do ask a consultation fee for my first consultation with people. And then after that first consultation, whatever future cost or fees is going to be, we will decide on together. If you do not wish to pay a consultation fee, I've got 8 other advisors in my company who at this stage is not charging consultation fees. So I can always put you in contact with them. Whatever they've learned from me. I train them, I guide them, and we discuss most clients. So if you do talk to one of them because you don't want to pay me a consultation fee, I will get to know what your circumstances is and help them with guidance. But please contact me and we can chat. What happened there? Oh, there we go. Bot, fantastic info. Thanks. Pleasure, Bot. Only a pleasure. Grip 27, is bonds a good investment? No, I think it's crap. Quite frankly, I think bonds is crap. Bonds is used in portfolios to eliminate a bit of risk. That's what it's all about. But bonds does not give a good return on investment. That's my personal opinion. A bond, I would say, is maybe ideal for somebody that is much older, that wants safety, that doesn't need growth, just wants to preserve their capital. And that's where a bond comes in very handy. Bonds are also good in portfolios, such as balanced portfolios, because there the portfolio manager can make use of that bond to move money out of equity into the bond in time periods when they believe that the market is going to go down and they want to get out of the market. But bonds overall, I don't dig it. I'm glad that they are in portfolios where they can be of use. But personally, I don't easily advise somebody to go into bonds. You have to have a very specific profile when I talk to you for a bond to become a worthwhile investment. Nico, I go on retirement in 4 years. I suppose it's 4 years from now. Can I move my pot 1 to pot 2 or 3 pot for retirement? Nico, you don't have to do that. Okay, so here's the thing, and I see I'm going to have to make another video about this 2-pot thing. The 2-pot terminology is just to explain to people how much money stays where. That's all the 2-pot does. So here's the thing. If you have 300,000 Rand in your retirement as of this 1st of September, retirement in your pension fund, provident fund, doesn't matter. That is what your fund is worth. Okay. So all they said is come the 1st of September, we're going to let you access some of the money. And they said, we will move 10% of your money into the savings pot. And that's where the 1-2-pot thingy started coming into the equation to try and explain to people where what fits in. So 300,000 you have, they said there's 10% of that is 30,000 Rand. We're moving it into the savings pot. You can outdraw it or you can leave it there. 270,000 stays in your vesting pot. But these two amounts is now not sitting in two different investments. It's still together. It's still 300,000 Rand. You're still getting the same growth. As long as you don't touch it, everything stays exactly the same because it stays in the same portfolio. It's just in the background. They make an entry almost like on an Excel spreadsheet to say 270,000 Rand of his money is in the vested pot, 30,000 Rand is in the savings pot. And then they've gone further, and this is why people now saying, is it now 2-pot or 3-pot? They said, going forward, every cent that you contribute will now go into one pot, which is that savings where your 30,000 is lying, and the other 2/3 goes into a separate pot. And that separate pot is basically the same as the vesting pot that we just talked about, the 270,000. So actually that 270,000 investing pot and the 2/3 of your contributions is actually the same thing. So that's the second pot. So what it now says is, we've now split your money, 270,000 investing pot, 30,000 Rand in the savings pot. You contribute now from here on 3,000 Rand per month. 1,000 Rand will also go into that savings pot so that you can withdraw it if you want to do it. The other 2,000 Rand goes into your retirement pot. You can't touch it. So that and the vesting pot is what you can't touch, never can touch, only at retirement. But the rest goes into the savings pot, which is that one pot that you can withdraw from now. Like I said, it is book entries. It's like entries on the Excel spreadsheet in the background. That's how they distinguish what money lies where, what can be drawn, what cannot be drawn, etc. But the long and the short of the whole exercise is that all these money, the vesting pot, the savings pot, and the 2/3 pot, all of it is together in one fund. And it grows together depending on how that fund is doing. So you don't have to move anything anywhere. Everything actually stays as it always was. It's just the terminology to try and tell people what they can and what they cannot do in terms of withdrawals. Please, Nico, whatever you do, just don't go and withdraw. People don't know how much they're hurting themselves. Okay, where was that? Ndlovukazi, I'm 42 years old. How much should I be saving for my retirement to live? I think you wanted to say you're 42 years old. How much should you be saving for my retirement to live comfortably? So, in order to live comfortably, if you started saving at, say, the age of 25, and you saved 15% per year, 15% per year of your gross income, you should be able to retire comfortably, okay? Every year that you get older and that you have not saved, you're going to have to save a bigger amount. So if you are 42 years old and you have not saved anything yet, you're most probably going to start looking at 25 to 30%, maybe a bit more, of your gross income that you're going to have to start saving in order to retire comfortably. And when I say retire comfortably, I'm talking here about retiring with an income that is going to be about 80% of your last year's income. So remember, for some people, they're happy to retire with 50% of their salary. For other people, they want to retire with 100% so that nothing changes. Other people want to retire with more money because they want to take overseas trips and whatever the case might be. Whatever is going to be your comfortable is what you have to determine. What do I want to have at retirement? And based on that, you have to go and plan how much you save. So I cannot tell you what you need to save to be comfortable. But if we talk about the normal rule of thumb of 80% of last year's income, you are most probably going to start looking at saving about 25 to 30% of your income. And every year you wait, it's going to get more difficult. So start saving. I'm happy to pay. It's your time. Thank you very much. And I must be honest with you, Nael, I never charged anybody for consultations for a very, very long time. And the only reason why I have started charging people is because I want to make certain that the person that wants to talk to me is serious about getting financial advice. The amount of time, my time that you're talking about, that I have wasted in setting up appointments with people that wanted help and then they don't pitch, just doesn't make it worth it anymore. And that is why I am charging a consultation fee. Thank you very much. I appreciate it. Call me, talk to me. We can set it up. Thank you for the info. Nico, glad I could help if it was of help. Let's see, what else? We've got another 4 minutes. And lo and behold, seems like I've gone through everything. Oh, yes, in Ndlovukazi. Can I book an appointment with you? I'm based in Pretoria. Yes, in Ndlovukazi, as a matter of fact, myself and my advisors are often in Pretoria. Same as what I just said to the previous person. Go to my profile. There's my WhatsApp the contact details and my website. You can either contact me on WhatsApp or via the contact page in my website, and we can set up an appointment. I'll tell you what my consultation fee is if you want to talk to me directly. Alternatively, I'll set you up with one of my advisors. And yes, we will help you with the greatest pleasure. We love helping people if we can. Peter Herps, hallo oom. Wat is save, buy properties and live from it? What is save, buy properties? What is save, buy properties and live from the income or invest and daily? Oh, okay. Sorry, mate. Pieter, so wat jy hier op my vra, is dit veiliger? Is it safer to buy properties and live on the income or invest and yearly live on the interest? Highly debatable this. And personally, I'm not a big fan of the properties. I don't know what they're talking about here. Okay. Whatever they say. Any case. Personally, I'm not the biggest fan of properties. And the reason why I'm not a very big fan of properties is that I don't believe a property is an asset until the day that it's paid off. The other thing is, if you've only got one property and you're renting out that property, if it's damaged, if you don't have a renter, whatever the case might be, then it might be a problem because now you're not getting an income. So my personal opinion is when it comes to properties, you only start really having a property asset if you've got at least 3, 4, 5 or more properties that's paid off, because then it's assets that paid off. And if you have one property that's standing empty, then you're just losing the rental income on one property. You've got the other 4 to cover you. Okay, so that's the first thing. How do I get to 5 properties? It's a hell of a lot of money that you have to spend in order to get to 5 properties. So I suppose that's the one thing. Then the second thing is when you do investments, just normal investments. Oh, what the heck is going on here? Sorry, I'm just seeing something. I'm trying to figure this out. The other thing is, if you just do a normal investment, then the nice thing with a normal investment is you can save on a month-to-month basis. You don't have to be paying off a property, and that money starts growing from the first rand that you started investing. So that's why I would say I prefer, personally, to just do normal investments. Because at the end of the day, if you go and compare the return on investment on both these, depending on was I luckier in properties or was I luckier in investments, you're going to get out at the end of the day most probably the same rate of return. If I look at the actual stats that we get on how the asset classes differ on a year-to-year basis, there's nothing that tells me that a property investment is better than an investment. As a matter of fact, it is just to me a scarier investment in that it does not provide the, the peace of mind in terms of I don't have to worry about people breaking my house, not renting, not paying, and then you also don't have the headaches of managing it. Somebody else is managing your money in investment. Love it a lot more. I sleep at night, they do the work. What are the costs involved in selling an investment property? Can't tell you. I do not do properties. I do not like properties, like I just said. So, sorry. Robocop, encourage more. Hey, Robocop, how's it, mate? I haven't spoken to you in a while. Restriction, what is that? Follows, duration, life restriction for someone. Your life contains... That is weird. I don't know that I talked about any of this stuff, but apparently I've got a restriction here that I've talked about something I shouldn't have. I love TikTok. You have to learn as you go. So ladies and gentlemen, let's see here. Yes, it's 7 bells. Can you believe it? Another hour is over and done with. It has been fun. I've really enjoyed talking to everybody. Next week, I'm going to have a special guest. I think you've all seen him because you've seen some of my videos. Tiaan Herselman from Old Mutual Wealth will be joining me next week. and the two of us will have a bit of a discussion and answer questions, same as what I'll do on a weekly basis. So all the best. Thank you very much for attending, and I wish you all a fantastic week. God bless. Oh, that's it. Yeah, I'm out of here. So you're just trying to figure out this. Okay. Sounds good.